Building $1 million portfolio sounds impossible to many people, especially when starting with relatively small monthly investments. But the surprising reality is that consistent investing, long-term compounding, and the right asset allocation can transform even modest contributions into significant wealth over time. The key isn't usually finding a secret stock or taking extreme risks. It's building a portfolio designed for steady growth, diversification, and consistency across decades. Today, we will talk about the exact portfolio that turns $500 a month into $1 in 20 years. So before we get started, make sure to hit that like button. Also subscribe to my channel. 10. The biggest lie about becoming a millionaire. Most people believe becoming a millionaire requires a massive salary, a lucky business idea, or some kind of financial breakthrough. Social media reinforces this constantly by making wealth look fast, dramatic, and almost impossible for ordinary people. But the truth is much less exciting and much more realistic. Many millionaires are not created through sudden success. They are created through consistency, compounding, and time. In fact, under the right conditions, someone investing a relatively modest amount every month can potentially build an enormous portfolio over a long enough period. The key is not necessarily how much you start with. The key is building a system that compounds continuously for decades without interruption. 9. The real secret is compounding, not picking perfect stocks. Most beginner investors become obsessed with finding the next big stock or timing the market perfectly. But historically, long-term wealth creation usually came from compounding rather than constant prediction. Compounding happens when investments generate returns, and those returns begin generating additional returns repeatedly over time. Early on, growth looks slow and almost disappointing, but after enough years, compounding accelerates dramatically. Eventually, the portfolio starts growing faster from investment gains than from the monthly contributions themselves. This is the moment when time begins working harder than effort. 8. Why $500 per month can become so powerful. At first glance, $500 per month does not sound life-changing. Many people underestimate small, consistent investing because the monthly amount feels ordinary. But consistency transforms ordinary contributions into something much larger over time. Investing $500 every month equals $6,000 per year. Over 20 years, that is $120,000 in total contributions. But the real growth comes from compounding returns layered on top of those contributions year after year. Depending on market performance, disciplined investing over long periods can potentially multiply those contributions several times over. 7. The portfolio is usually simpler than people expect. One of the biggest surprises in investing is that many successful long-term portfolios are actually very simple. Instead of chasing hype constantly, disciplined investors often focus on diversified index funds, ETFs, and broad market exposure. A common long-term growth portfolio may include a large allocation toward U.S. stock index funds, international market exposure, and smaller positions in growth-oriented assets. The goal is not excitement. The goal is sustainable compounding over decades while minimizing unnecessary risk and emotional decision-making. 6. A high-growth portfolio usually prioritizes equities. For someone with a long 20-year investing timeline, equities often become the foundation of growth because stocks historically produced higher long-term returns than cash or bonds. Many aggressive long-term investors may structure portfolios heavily around broad stock market ETFs because businesses tend to grow alongside economies, innovation, and productivity over time. While markets remain volatile in the short term, long investment horizons allow compounding to potentially overcome temporary downturns and crashes. 5. Consistency matters more than market timing. One reason many investors fail is because they wait endlessly for the perfect time to invest. They fear crashes, recessions, or temporary volatility. But historically, consistent investing often outperformed emotional market timing attempts. Monthly investing during both good markets and bad markets allows investors to buy more shares when prices fall and fewer when prices rise. Over decades, this process smooths out volatility and keeps compounding moving forward regardless of short-term fear. 4. The real danger is quitting too early. The hardest part of building long-term wealth is not choosing investments. It is staying invested long enough. Most people underestimate how emotionally difficult investing becomes during crashes. Portfolios fall. Headlines create fear. Recessions create uncertainty. Many investors panic and stop investing exactly when long-term opportunities become strongest. The investors who ultimately build large portfolios are often not the smartest stock pickers, but the people who survive emotionally through multiple market cycles without abandoning the process. 3. Increasing contributions changes everything. While $500 per month alone can build substantial wealth over time, increasing contributions gradually can dramatically accelerate results. Raises, side income, bonuses, or reduced expenses can all be redirected into investments. Even small increases over time create major long-term effects, because larger contributions compound alongside existing growth. Investors who increase contributions consistently often reach financial goals far faster than they originally expected. 2. The $1 million goal depends heavily on returns, and time reaching $1 million with $500 monthly contributions depends heavily on market returns, consistency, and investment duration. Historically, stock markets produce strong long-term average returns over extended periods, but returns are never guaranteed. Some periods outperform expectations, while others underperform for years. This is why patience matters so much. The longer the investing horizon, the more time compounding has to potentially recover from downturns and accelerate growth later in the journey. 1. The exact portfolio matters less than building a system. You never stop following the deeper truth about building a $1 million portfolio, is that success usually comes less from finding magical investments and more from building a disciplined, long-term system. Because the truth is simple: broad diversification, consistent investing, long-term patience, reinvesting gains, and allowing compounding to operate uninterrupted for decades historically created enormous wealth for ordinary investors willing to stay committed long enough. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.